Thanks for having me. It's nice to be back in Utah. I spent a year of high school at the Winter Sports School in Park City, Utah, when I was pursuing a ski career. So it's nice to be back. It's nice to see snow on the ground. I'm really sad I'm missing the ski day, but hopefully you guys have some great conditions out there. If we have the slide deck up, my clicker is moving a little too fast for me. I just want to walk through a little bit of our kind of macroeconomic and market overview. I haven't done a stage presentation in quite some time. I think we can blame the pandemic, so I might be a little rusty. We're going to save time at the end for Q&A, hopefully like 15 minutes or so. But if I say something that kind of sparks your curiosity or you have a question during the presentation, just raise your hand and I'm happy to take it as I walk through this slide deck as well. So where I'd like to start is our outlook that we wrote in December 2021 coming into this year. And I think from our perspective, it might seem like the entire world has changed from an economic and market perspective. The S&P 500, which is the kind of benchmark indicator for U.S. equity markets, is down around 15% year to date. Inflation is still soaring. The Federal Reserve is set to embark on a rate hiking cycle. So it seems like a lot of stuff has changed. But we think there are some kind of key elements that still exist in the undercurrents here that investors should pay attention to. On the left-hand side of this page, we just list 3 factors that we see that are going to drive a kind of a vibrant economic cycle. And I think that word vibrant is really important. We titled our outlook, Preparing for a Vibrant Cycle. We spend a lot of time thinking about what the title should be because a lot of times that's the only thing people will read. So we have to convey a lot of information there. What we want to say about vibrancy and what we want to convey is that the previous kind of 10 years in the post-global financial crisis period were really marked by a bad economy. There was kind of stagnant global trade, weak demand from consumers. Corporates and households were focused on deleveraging. There weren't a lot of inflationary impulses. There wasn't a lot of business dynamism. The only real sector of the economy that was exciting and that investors were willing to pay a premium for was kind of the digital infrastructure and digital build-out, which is why you saw companies like Facebook or Netflix or Google really dominate stock market indices. And we think that kind of era is coming to an end, or at least evolving into a new kind of more vibrant, more equitable environment for companies. So the reasons for that are threefold in our view. One is policymaker priorities. We can talk more about this as we go through the presentation. But the key takeaway is that in the post-financial crisis period, fiscal policymakers were focused on austerity. They were focused on tightening their belts, reducing the deficit, reducing government debts, and they thought that was the best way forward. In the COVID crisis, that completely flipped the script. The reason why the economy has rebounded so strongly from the COVID crisis is because policymakers around the world realized that replacing people's incomes was the way to go. And by sending out augmented unemployment benefits, stimulus checks, et cetera, they really cut off the kind of most devastating impacts of what could have been a really damaging economic recession. So policymakers generally are in a much more supportive stance for markets. And the conflict between Russia and Ukraine is complicating this further, and we can get into that a little bit more later. The second thing is that households and consumers are much healthier now than they were in the 2010s. So when we look at things like household balance sheets, debt service to income ratios are at all-time lows, wage growth is strong, they have excess savings that built up during the pandemic. All of that should support continued consumer growth and consumption growth, which should support the economy broadly. And then on the corporate side, balance sheets have delevered. They're facing strong demand for their goods. They have a lot of problems that they need to solve in terms of supply chains and shortages, et cetera. But we think that corporates broadly have the ability to do that. But generally, their corporate health is robust, and you can see that in margins and other indicators. And then finally, what this conference is kind of all about is innovation. The last cycle to us was characterized by the digital build-out, so really the focus on things like cloud computing, artificial intelligence, machine learning, et cetera. On the tech side, And now that technology is being infused in sectors across the economy. So we think that investors generally have a much broader pond to fish in. The example I always use is John Deere, which makes like tractors and lawnmowers. What John Deere is doing to differentiate themselves is they're innovating in terms of self-driving tractors, testing the soil that farmers work on, using machine learning and artificial intelligence to kind of calculate when the best time to harvest crops will be. So it's a company that's in the old sector of the economy. It's been around since the 1800s. It's not something that you would think of as like an exciting or sexy innovator, but they're differentiating themselves through innovation, and we think that's going to be a powerful trend throughout this cycle. On the flip side, there are obviously risks that we need to watch. In December, the main risk that we were focused on is China's economy, how they were dealing with a potential real estate slowdown there. That risk has kind of diminished. People aren't as focused on it, I think for obvious reasons. The main one being that there's a shooting war in Europe for really the first time since World War II. And investors are trying to think through the economic implications of that. We have some thoughts that we can get into in a little bit. And then the second big thing that's changed is, what is the Federal Reserve going to do about inflation? As we were coming out of the pandemic and really going through a powerful, robust surge in economic growth, that led to a lot of problems in the economy that had really adjusted to that period of kind of tepid trade and weak demand that I was talking about before. The example that I like to use is that spending on goods in the United States is $700 billion above pre-pandemic trend, whereas spending on services is still $300 billion below pre-pandemic trend. So you completely altered the way that Americans spend their money, and supply chains just aren't equipped to handle that amount of physical goods that need to get manufactured, shipped globally, and then transferred around the country. And you're seeing a lot of problems based on that. To us, that's kind of the main driver of the inflation that we're seeing. The issue is that the Federal Reserve doesn't really have time to wait and see if that inflation is indeed transitory. They're responsible for two things in the economy: making sure that we're at maximum employment, so making sure the most people possible have jobs, and then two, making sure that prices are stable. So making sure inflation is at a rate that's tolerable for the economy, which officially in their target is like 2%. Headline inflation right now is at 7%. Everyone expects that to go down, but the Fed doesn't really have a choice but to start raising interest rates in order to slow the economy to help control inflation. Finally, we're still watching COVID as a risk. In the US, it seems like we've really turned a corner after the Omicron variant. Of course, with new variants, it's hard to make a real high conviction stand that this is finally over, so I'm knocking on wood mentally. But it seems like, at least from an economic perspective, the biggest impacts of COVID are behind us. What we're watching now is China, because China has had a zero COVID policy for the entirety of the pandemic, and their dismount from that stance to a more open, normalized economic environment is going to be very difficult, just because they don't have the same amount of natural immunity that the United States does. They don't have the same amount of vaccine penetration as the United States does, and it's going to be really interesting to see how they transition from this kind of zero COVID approach to a more normalized, open economic environment. So that's really the high level of what we think. If I could summarize, I'll try to summarize it briefly. In December, we thought that this year would be categorized by a strong economy and strong markets. And I think what we're seeing so far this year is a continued strong economy, but markets that are very skittish. So through this presentation, I'll try to talk about some of the reasons why both of those things are true. Everyone good? Any questions so far? Yeah, go ahead. So the question was around China starting their own war. Can I say that for the end? I need to put together my thoughts. All right. So this is kind of the landscape. And there's a lot of words on this page, but basically what you need to know is what I said before, which is that the fiscal stance from both the United States and Europe very importantly, is different than it was in the post-global financial crisis period. The Biden White House has kind of shifted their stance on Build Back Better. They did a little rebrand, but basically what it tries to do is engender domestic manufacturing, add a little bit more support for Medicare, add incentives for officially strategically important industries like semiconductors, and then, of course, climate change. Same deal in Europe. The big shift in Europe that's happening right now is that the Russian invasion of Ukraine is really catalyzing continued fiscal unity. So Europe has a really interesting system where they have the same monetary policy, so they use the same currency, they have the same entity, setting interest rates, but they don't have fiscal unity. So each country's government sets their own budget, their own taxation, et cetera. That has been a kind of awkward adjustment for markets to understand. But what's been happening from what's been catalyzed by crises, first COVID and now Russia, Ukraine, is a more integrated Europe. So there's an idea out there that Europe will become more fiscally integrated as well as monetarily integrated. And that could be a positive for the global economy just because it would lead to a little bit more of a seamless economic environment. Latin America is an interesting region to watch right now, especially in light of the kind of sanctions that have been put in place on the Russian economy and Russian commodities, just because Latin America is the only other source for a lot of the agricultural, energy, and mineral products that do exist in Russia and Ukraine. So places like Brazil are benefiting a lot from the kind of shift in sourcing for materials like that. In Asia, I mentioned earlier that China is in this kind of awkward position where they've used a ton of debt to build up their economy over the last 20 years, and now they're at a point where they need to focus on reducing that debt and reducing that leverage. So watching what Chinese policymakers do in terms of reducing reliance on debt to fund growth is going to be interesting for the global economy just because China is the world's second largest economy and is a huge source of demand for things like commodities, agriculture, energy, et cetera. So that's kind of the broad kind of fiscal backdrop. The Russia-Ukraine situation throws a wrench into all of that. What we want to show on this chart is how Russia-Ukraine actually feeds through to markets and economics. A lot of times when we talk to investors, the worries that they bring up or the concerns that they have are these kind of geopolitical issues that dominate the kind of headlines on CNN or Fox or MSNBC or whichever news channel you watch. When we think about geopolitical impacts, it comes down to the linkages in the economy and financial markets that we do see. So the energy sector is clearly the most important flow through of the Russia-Ukraine conflict to the global economy. You saw crude oil prices spike to like $130 a barrel, call it, which is some of the highest levels since the early 2010s. People are worried about that just because gasoline and energy is an unsubstitutable, at least at this point, cost for both businesses and consumers. So the idea is if you have to spend $4.50 a gallon, I'm not sure, I haven't seen a gas station in Salt Lake yet, but I'm not sure what gas prices are here. You have to take that spending and substitute something else out of the picture. That's the fear, that higher energy prices are actually going to pinch consumers and lead to lower spending in other places. This issue is much more important for Europe than it is for the United States. I think you can see that on the chart. The U.S. is largely energy independent. So we're a net oil exporter. The shale revolution has really changed the picture for the United States. And we also generate most of our own electricity as well. That's not the case for Europe. They're heavily reliant on Russian gas and oil exports, which is why the kind of sanction picture has been so tedious and why countries like Germany are kind of against fully sanctioning Russian gas and oil exports because it would really crush their energy markets. The other kind of linkage that we're watching in terms of the Russia-Ukraine conflict is how much exposure European banks have to Russian companies. From their peaks to the lows, European bank stocks were down something like 40%. They had a massive snapback rally today. We'll see if it sticks or not. But That just shows how concerned markets are about exposure to this for Europe. The US has been much more isolated. So overall, with the conflict, we think it does pose risks through that energy channel. But ultimately, we think that the US economy, which is generally a pretty closed, insulated, services and consumer-driven economy, will be able to power through the disruptions that are caused by this conflict in Ukraine. And this is really the reason why. The underpinning of our view, which is pretty high conviction, is that the US consumer is in phenomenal shape and is in much better shape than a lot of people are giving them credit for. The chart on the kind of series of charts on the left just shows the kind of 3 lines of defense that consumers have. The top chart shows the excess savings that consumers accumulated throughout the pandemic. So if you think about every foregone trip to the restaurant, every foregone cruise, every foregone vacation to Disney World, a lot of that savings got socked away. So savings is well above normal. Second of all, wage growth is the strongest that it's been since the early 1990s. So far, what we've seen is consumers are funding a lot of their new spending through actual wage growth. They're not spending down their excess savings that they accumulated during the pandemic, and they're also not taking on new leverage, right? The final chart just shows debt service to income ratios, which I mentioned in my lead up. That ratio is at all-time lows. So whenever we hear kind of a bear case or a case about consumer slowdown in the economy, you have to first say that wage growth cools off and they aren't able to spend for their consumption based on wage gains. Second of all, you have to assume that they start to spend down their excess savings that they accumulated during the pandemic. And then third, you have to assume that they never relever. They never take out another loan from the bank. They don't start spending spending more on their credit card balances, et cetera. What this translates to is corporate strength, right? There's a beneficial cycle that happens between consumer spending, increased demand, corporate investment to meet that demand, hiring to fulfill that demand, and then further wage gains and further incomes. Economic cycles take a long time because there's a lot of positive momentum that builds up in this cycle and in this relationship. And right now it seems like a lot of people have a kind of anchoring effect on the 2010s where the economy was much more fragile than it is today. Consumers were focused on deleveraging, wage growth was weak, and they didn't have a lot of excess savings. So everyone was really nervous about what was to come, right? And that leads to tepid demand, a lot of tightening the belt, not a lot of hiring, not a lot of bargaining power for labor, and you're seeing the opposite during this cycle. And we think that ultimately it's a good thing and it's a positive for the economy that we're seeing it, and we should see continued earnings growth for US corporations. The big pushback is, when is inflation going to start hitting margins? And when is inflation going to become a problem? And when is the Fed going to raise rates and cause a recession to get a hold of it, right? Inflation is certainly the most confusing thing and the biggest debate that is happening in economist circles, which tend to be pretty boring, but this is actually a pretty lively debate. There are two sides of the camp. Side one is arguing that the unemployment rate is below 4%. Companies can't find labor, they can't find workers, and it's going to lead to a wage price spiral, which basically means companies have to pay more to attract workers to work for them, and then raise prices on top of that to defend their margins. And based on that, workers are going to demand higher wages so they can maintain their adjusted cost of living and real incomes. And you get into a kind of vicious cycle where that continues upon itself, and you end up with inflation at 10, 12, 14%, like we saw in the 1970s. So that's camp one. Camp two says, hold on a second. What we did was we shut down the economy for 3 months at the beginning of the pandemic, like flipped a light switch, and then we turned the light switch on and shoved a bunch of fiscal and monetary stimulus on the economy to jumpstart it. And what we're seeing is this inflation is the cost that we're paying to have a really rapid recovery from the pandemic-caused recession. What supports that argument is that the sectors that are causing the most inflation on both the goods side and the labor side are the ones that are most impacted by the pandemic. So the chart on the left just breaks down inflation by category. The stat to take away is that from the end of 2019 until now, 1/3 of the inflation that consumers are faced with comes from autos. So think rental car prices, used car prices, new car prices. That altogether only makes up 7% of consumers' wallet share. So you have a really small slice of the pie driving a really outsized portion of the inflation that we're seeing. That to us suggests that there was a big kind of microeconomic disruption in one sector that isn't necessarily being caused by an overheating economy. On the labor side, you can see it if you break it down into micro categories. So one of the occupations that has the highest wage growth is nursing home workers. And it's not hard to figure out why nursing home workers are seeing some of the highest wage growth. It's because no one wants to work for minimum wage in a nursing home when there's a pandemic that impacts the elderly most acutely, right? So what you're seeing is a big allocation mismatch problem in the economy that's leading to inflationary pressures. When I don't know how many people moved to Boise, Idaho over the pandemic. Is anyone here from Boise? How crazy is Boise now, like from 2 years ago? It's one of the cities in the country that's seen the most accelerated growth throughout the pandemic. But really what you have is a massive imbalance between housing supply and demand in places like Boise or like Tampa, Florida, lower cost of living places. And you don't have the infrastructure in place to meet the demand where it exists. And the only outlet for that is prices, okay? So there's two sides to the story. One is very macro top-down based that just says, look at the unemployment rate, look at the fact that companies can't hire workers, the employment is full and inflation is soaring, and the Fed should raise rates to kind of cool it all off. And the other side of the camp says, wait a second, this inflation is just being caused by the pandemic, and if you raise interest rates now to slow growth down, you're just locking in a pretty negative equilibrium for the economy where workers aren't in the right place. We have a massive housing shortage in the country that you won't solve because you cause a recession. And you're just stuck in this kind of environment of shortages and paying for longer just to curb inflation. So what we need to think about is, what is the Federal Reserve going to do about this? And what is it really going to take to get inflation down to more tolerable levels, right? The tolerable levels is an interesting debate to have. The Federal Reserve's target, what they want inflation to be at, is 2%. To us, that seems like a tough task to get inflation down to 2% without a really material recession this year. So is 3.5%, 4% inflation tolerable enough? We would argue it is, just because you need a little bit of a hotter economy to deal with a lot of the problems that the economy is facing. But the Fed has its work cut out for it. What we expect this year is about 5 to 6 25 basis point interest rate hikes. What that means for everyone is that hopefully by the end of the year in your checking or savings account, you should be able to get some sort of positive yield on your balances. But for investors, all that's meant to do is just make us think. Because for the last 2 years with interest rates at 0 and with bond yields at 0, so your safe assets aren't returning you anything and you have a high inflation environment, there's really been only one choice, which is to buy equities. The corollary for the real economy is there's not really a choice. You're not just going to sit on your cash because you're losing purchasing power to inflation. So you have to invest in an actual business, in the economy. You have to borrow and buy a house. That's what you're being incentivized to do. I mean, if you took out a mortgage at the beginning of the pandemic for, like, I don't know what it was, 2.75%, Ryan's nodding. It seems like that's what he was offering at the private bank. If you're interested, just ask him. So if you took out a mortgage at 30-year mortgage at 2.75% at the beginning of the pandemic, and then you've seen your home price appreciate by 30% over that period, you just beat every hedge fund on Wall Street with your return on equity there. The Fed is trying to change that equation. They're trying to stop and make everyone think about, what should I actually do with my capital? Is 1.5%, is 2% on my checking or savings account enough to just keep my money safe and save it? Or am I still incentivized to invest in the real economy or in the stock markets? And that's the question that markets are toying with now. Is 1.5% on a 2-year treasury bond a good enough compensation for me to not take any more risk in the stock market? I'll just pause there because that was kind of like the macro, and now this is more of the fun part. This whole conference is really centered on innovation and around the trends that we're excited about. We're watching these as both public and private market investors at the private bank. We're bullish on digital transformation. We're bullish on healthcare innovation. We're bullish on sustainability. We think there's going to be tremendous and rapid change over the next 10, 15, 20 years in all of these areas. And investing in them now seems appropriate because I don't really have to worry too much about what the Fed is going to do this year, or what inflation is going to do this year, or what's going to happen with the war in Russia and Ukraine, or what's going to happen with oil prices. What I know is that the corporate and consumer and political discourse is driving a lot of these accelerated changes, and it's going to be a multi-decade investment that I can make, and that I can kind of ride the wave. So you just see some of our projections for some of the areas in particular here. The chart on the top just shows research and development spending, software and automation spending, and info processing as a percentage of GDP. You can see that that's at all-time highs and rising. In our view, this is going to lead to a more productive economy. It's going to lead to a brighter economy, and we're just optimistic for the world based on those 3 factors. So I only have 3 minutes left. I kind of covered COVID. It seems like it's, the U.S. is kind of over it, and it's probably debatable how long the U.S. has been over it, which seems, for some places like a long time. But as I mentioned before, like China is in a very different place. So that's the big risk with COVID that we're watching at this point. The final thing I'll say is that the most basic question that investors ask us is like, where are we in the economic cycle? And should I be worried that we're going to go into a recession and that the equities that I own in my portfolio are going to go down 20, 30, 40, 50%? That's like the most basic question that we can ask and answer. And it drives a lot of the decision making that we make in terms of how we manage portfolios. You can see based on the table below that the picture is very muddled, right? There's some of these indicators that say we're still very early in the economic cycle. There's some indicators like inflation in the labor market that tell us that we're late in the economic cycle. There's still a couple of indicators that say we're in a mid-cycle environment. When we put it all together based on both our like qualitative and quantitative data, we still feel pretty comfortable saying that we're in a mid-cycle environment here, and we feel comfortable with a pretty optimistic outlook for both the economy and risk assets like equities from here. So that's kind of the key takeaway and the answer to that big question that we're asking. I do have some more slides in here in the back that maybe we'll hit on, but I'll just pause here to see if there are questions from the audience. Go ahead. And do we have mics? I think, yeah, we might have mics. Great.
Question on the early cycle dynamics and the late cycle dynamics that are highlighted. Have we experienced this before where consumer confidence is this low, and yet you look at the percentages of GDP with capital and residential investments?
Yeah, that's a fascinating question. Consumer confidence is putrid right now. When you look at survey data, whether it's from the University of Michigan or the Conference Board or what have you, the University of Michigan in particular is, if you survey consumers, they think that the economy is worse now than it was at the depths of the global financial crisis, which based on their actual activity is almost certifiably false, right? Their consumption is higher now, their home prices are higher now, their 401k balances are higher now. What we're sensing is that the economic and consumer confidence is being heavily impacted by inflation, right? So people say, okay, inflation's at 7%, that has to mean that the economy is really bad. And then the other interesting thing that we've been thinking is that whenever you go to a restaurant and they say that, oh, we can't seat you, and you see open tables, and you ask why, and they say, well, we don't have enough staff to serve those tables. When you see help wanted signs in the windows, a lot of people associate that with the fact that unemployment is actually high, but really the unemployment rate is very low, and there aren't actually enough workers to fill those roles. So a lot of the ways that consumers interact with the economy feel worse now, even though from our perspective, all those indicators are a sign of health. So I would love to hear if anyone else has any other theories about why consumer confidence is so low, but to us, those two things really matter. The final thing is the pandemic, right? The pandemic is the one thing that's been a global consistent across the last 2.5 years. And even if you look at consumer confidence in places like New Zealand, where the pandemic kind of intervention has been much more stringent and rigorous, consumer confidence is low there as well. So I think there's a lot of factors that go into this. But from my perspective, which is like investment strategist, when I look at all the economic data, it looks incredibly robust. And I would never say that the economy is just as bad now as it was at the depths of the global financial crisis. But that's a great question. Yeah, go ahead.
All right,
Oh, you're going to get a mic.
all right, can you hear me?
Yes.
So Jake, that was a really great explanation about inflation. And then to flip the switch, I mean, it rings so true. So I still think that consumer confidence is down because of fear and confusion. Mm-hmm. They just don't know. And even though there's so many reasons for them not to be afraid and not to be confused. Another thing on labor I wanted to just mention is immigration, which is always a hot button. But the people who usually take a lot of the jobs in this country either have died, because so many people almost 1 million people have died. And if you look at those numbers and you look at how many people have died, they're equivalent to wiping out all the teachers in America, all the healthcare workers in America. So it's pretty dramatic, that number. And then immigration, which normally fills in, hasn't kicked in. So, I mean, I think that's, while it's a hot button, don't you think that's something that still needs to be addressed? Because we've gone from 1 million people a year to 260,000.
Yeah.
That's like a huge number.
Absolutely. We just made a slide that I'm going to make sure gets added to my slide pack when I do more presentations like this, that just breaks down where the worker shortages are actually coming from. So let's just, the number, it's an estimate, but say there's 7 million workers short in the labor supply from the pre-pandemic trend, what you would expect if the pandemic never happened. About 1 million of those workers are from limited immigration. About another 1 million are from people who are still not at work because they don't want to be around unvaccinated people and they're still worried about COVID. There's about another 1 million that are not working because they can't find childcare. And then there's about 2 million people that retired early because they saw what happened to their 401k or their IRA or their home price, and they realized that they hit their retirement bogey early. So the early retirees probably aren't coming back, but as you get past the pandemic, which it will end at some point, right? I'm in a room of more medical professionals than me, but I think you would all agree that at some point it will end. You should start to see some of those trends reverse and alleviate, especially with those who are fearful of COVID and those who are worried about childcare. The immigration is a factor just because there wasn't a lot of cross-border movement during the pandemic, but still politically we haven't solved that issue yet. But I agree that increased inflation would alleviate a lot of those labor shortage issues and would help to increase labor supply. So those are all points that we agree with. Yeah. And it might take a while to get a mic. No, he's jogging. We're good.
Hi, I'm Keon. I'm a practicing physician. So I hate to put you on the spot, but
Yep.
If you look at your slide there, there's a lot more data points that suggest late cycle rather than mid-cycle. So what are the things that, if you're going to be a predictor, you're looking out for that could be leading to a recession? In 2008, we were talking about the housing market, but
Right.
what things worry you that would tumble the economy in the next, couple years?
Yeah, I think it's a great question, and indeed, it's the most important thing that we look at. The key reason why I'm pretty confident in the health of the U.S. economy just comes back to this idea that the U.S. consumer is healthy. And despite what they say in surveys about their sentiment and their economic confidence, they're seeing their wage gains, they're seeing healthy incomes, they're seeing the excess savings that they have on their balance sheet, and they're seeing their ability to relever. And to me, when that starts to crack, we have an issue. I was to give a little bit more specifics of things I'm watching to start to see if there actually is a consumer slowdown. And this actually ties into the kind of gas prices too. Thor Industries makes RVs. They reported their earnings this morning that beat estimates. The stock was trading up like 10% in the pre-market. Their backlog is $17 billion, and they're booked into 2023. So no matter what consumers are saying about how they feel about the economy, they're still buying RVs. If there was some sort of like disconcerting feeling that people were worried about losing their job or incomes falling or they're over levered already, the first thing that they would stop purchasing is RVs. So like spending on things like jet skis, boats. I was meeting with some clients this morning that are involved in the automotive industry. They're not seeing any signs of slowdown in their car dealerships. It's that kind of like big ticket discretionary spending that's going to start to get hit first if we do see some kind of real decline in consumer confidence and consumer spending. And so far, we just haven't seen it. Corporate CapEx intentions are still very elevated, which suggests that companies are going to be investing in new facilities, investing in new capacity, hiring more workers, et cetera. And there's just a pretty tremendous positive momentum there. The issue is the big economic recessions that we've seen in the last 40 years, 30 years have been really bad. So like in 2000, you had the tech bubble where the NASDAQ sold off by like 70% and the S&P 500 was down 60% just because that whole sector of the investment complex was extremely overvalued and overhyped. It was eventually right? The internet's amazing and it did change the world. It's just that everyone was 15 years too early. The housing bubble and the global financial crisis was the biggest economic disaster since the Great Depression. And then you had a once in a lifetime, once in a century pandemic that shut down the global economy in 2020. So investors are kind of used to this idea that there's going to be a big one or a big thing or a big shock that really craters the economy and craters the stock market. But if you look at market history, it's more likely that you see kind of this process of businesses get overconfident, they build a little too much excess capacity, they have to shut it down, people lever up a little bit too far, they get in over their skis and they have to delever. And you see a mild slowdown and a mild deleveraging process, mild at least relative to like global financial crisis. But we're not close to that process. And to me, it comes down to debt and debt growth, which just hasn't really started yet. That's really when you get into problems is when the economy is over-levered. And I think that's where, like, if I shade myself towards the more early to mid-cycle, that's really where it comes from. So I know I gave you a very optimistic read on your question, which is like what could cause a recession here. But it's, where we have conviction is that it's going to take a little bit more time for imbalances to grow in the economy to really cause a material kind of slowdown. China. Oh, you want to answer his question about China starting a war? I'm not a geopolitical expert. I'm a financial analyst / investment strategist / writer of a newsletter. I know just as much about what President Xi wants to do as everyone else. The one comment I would make is that, before Putin actually invaded Ukraine, the consensus thinking, at least on Wall Street and the analysts the geopolitical analysts that Wall Street listens to, was that Putin would roll in and take over Ukraine over the weekend, and it would kind of be that was that, and it would really embolden China to do the same thing with Taiwan. I think that really underestimated the power of Europe and the United States to impose really economically damaging sanctions to Russia. The Russian economy is going back to 1985, and it's not going to change anytime soon, even if there is a quick resolution to this war. The key example is, like, imagine if you're in Moscow commuting and you go to the subway and you kind of try to scan your Apple Pay to get onto the subway, and it just doesn't work anymore because Apple cut off its relationship with Russia. So you have to scramble to get cash to get on the subway. Like, that's a real tangible impact of being cut off from the modern global economy. And that's going to be felt in Russia for many years, no matter what happens with this conflict. The second thing is, it's not as easy as it seems to kind of invade and occupy another country. So in my take is that it actually should make Xi a little bit more cautious about making a play for Taiwan, because it's been such a disaster for Russia and Putin so far, especially relative to what the expectations were coming into it. You know, Xi is and our take on China and what gives us some stasis and confidence when we're making investment decisions is that generally they're rational actors, and that they're interested in economic prosperity and economic growth, and they might have, you know, a very different idea of what an economy should look like than U.S. entrepreneurs, but it's still getting to the same goal. And it just doesn't seem like China starting a war with Taiwan furthers that goal in a beneficial way. So that's my uninformed takeaway. All right, we have 3 minutes left, so probably can answer one or two more questions. Oh, right here.
I've just got a quick one for you. Just, you know, based on the commentary around, you know, the consumer as well as rising rates, just wondered what your current positioning is relative to debt versus equity, growth versus value, and then any sectors, you know, over versus underweight.
Yeah, thanks for reminding me. I should have made it to this slide. I'm sorry, Ryan. I apologize. So we favor stocks to bonds. Basically, it comes down to the fact that we see a robust economic environment. We think corporate earnings are going to grow. There's going to be risk factors along the way. But when you're in kind of an elevated inflation, strong economic growth environment, we'd rather take our chances with stocks and all of the risks that can hit the stock market relative to being in fixed income. That said, fixed income is more attractive now than it has been in the last 2.5 years. So we moved from kind of max underweight positioning in core fixed income towards closing that underweight. When the 10-year yield gets to somewhere like, you know, 215, we'll be talking about further closing that underweight and moving to kind of neutral fixed income. The sector question is interesting. I tend not to focus on the traditional sectors that Wall Street uses, so think like financials, energy, technology, consumer discretionary, whatever. I like to think more about like what companies do and what they're exposed to. And I think the easiest way to think about it now, what we like, is companies with a cyclical bent that are aligned with secular trends. So think about like a secular trend that's happening with a company that's involved in the physical economy. This isn't like a stock recommendation. This is just an example. So just if my compliance partners are listening, it's just an example. But a company like Generac, which makes generators and is involved in battery storage, right? That's something that's kind of the profile of the company that we're looking for that we like in this environment. The other thing that's interesting to us is real assets for inflation protection. So obviously being a landlord is a really good way to get some inflation protection in your portfolio because you can reset your rents higher with prices. A lot of people ask about gold as an inflation hedge. To us, it doesn't make a lot of sense to own gold in a rising rate environment because gold doesn't pay you any income. It doesn't pay you a coupon. So the higher interest rates go and the higher bond yields go and the higher savings rates go, the less attractive gold looks. So we kind of avoid gold and look to more of those real income-generating assets with built-in inflation protection there. So that's kind of our positioning and what we like. Thanks for asking that question. I should have brought it up in the main bulk of my presentation. All right. If there aren't any last ones, thanks a lot for having me. I really appreciate it. I hope you guys have a great ski day and a great rest of the day with presentations.